Welcome to The Explainer from TalkTickers. Today, we are digging into XP Inc.'s second quarter 2025 earnings. And honestly, they presented a real puzzle for investors.
So, on the one hand, the company announced its highest profit in history, right? An impressive 18% jump year over year. But then, on the other hand, the stock immediately cratered, tumbling nearly 9% on some really heavy volume. So what is going on here? Let's dig in.
Yeah, exactly. Those two numbers, they just don't add up, do they? So let's unpack all the data and see if we can solve this puzzle together.
All right, first things first, let's look at the good news. Because, on the surface, these results looked absolutely amazing.
Okay, get this. The company hit its highest net income ever. We're talking 1.3 billion reals. That's not just a record, It's a huge sign of a powerful earnings engine just humming along.
And this wasn't just some one-off fluke. Their profitability metrics were fantastic. Take return on average equity. That's basically a measure of how good they are at using their money to make more money. It came in at over 24%. That shows they're being super efficient with their capital, quarter after quarter.
And what's really cool is how this helps shareholders directly. Their earnings per share actually grew faster than their net income, a full 22% jump. Now that is the power of a smart share buyback program. It literally boosts the value for every single share that's left.
On top of all that, their capital position is like a fortress. They're way above their targets. And because of that strength, management can confidently keep giving capital back to shareholders. So you see the problem, right? With all this great news, the mystery of that stock drop just gets deeper.
But the market was clearly looking right past all these profits. It was zeroed in on a few other key details. Details that told a very, very different story.
The first clue? A pretty small revenue miss, about 1.9%. Now look, that's not a huge disaster on its own, but it was the first crack in the armor, the first sign that maybe that top-line growth wasn't quite as strong as everyone hoped.
Okay, but this was the number that really sent a chill down Wall Street's spine. Net new money, that's the lifeblood for a platform like this. It didn't just slow down, it plunged 70% from the year before. That's a massive red flag signaling a huge slowdown in bringing in new client money.
And when you dig into the numbers, you can see exactly where the problem is. The retail side, regular investors, that was actually pretty healthy, bringing in 16 billion reals. But that was almost completely wiped out by a 6 billion outflow from their corporate and institutional clients.
So why are the big corporate clients pulling their money? Well, management pointed to something called reciprocity. It's kind of a you scratch my back, I'll scratch yours deal. In this high interest rate world, other banks are basically telling companies, hey, you want a big loan from us? You better keep your investment cash with us too. And that's been a major headwind for XP.
And this really gets to the heart of the matter. Right now, investors are in a show-me-the-growth phase. Record profits are nice, sure, but the market is prioritizing growth and inflows over everything else. That massive slowdown was the red flag that just overshadowed all the good news on profits.
Okay, so with all that pressure, how is the company responding? Well, on the earnings call, management laid out a really clear long-term game plan.
They used the word obsessive to describe their focus, which I thought was really interesting. They're basically doubling down on making the client experience and their products the absolute best they can be. That's the core of their strategy to win this fight.
A huge part of this strategy is a shift in how they make money. They want to move towards a more stable, recurring revenue model. Right now, only a tiny 5% of their assets are in this model. Compare that to developed markets, where it's closer to 50%. You can see the opportunity here is just massive. So, their plan to get growth back on track has three main parts. 1, diversify where their business comes from. 2, get existing clients to use more of their products, like cards and insurance. And 3, make their financial advisors more productive by giving them better tech and support.
All right, let's put it all together. It's time to put on our analyst hat and figure out what this all means for the future. When you look at the outlook, it really boils down to two competing stories, two possible futures for the stock, the bull case and the bear case.
The bull case is pretty simple. It's all about the macro picture. If Brazil's central bank starts cutting interest rates, that could be a huge tailwind. It would make investors more willing to take risks, drive money into the exact kind of products XP offers, and boom, the narrative shifts right back to that incredible profit engine we talked about earlier.
The bear case, on the other hand, is that these problems are sticky. The reciprocity pressure from banks continues to drain corporate assets.
The internal changes to make advisors more productive just happen too slowly. And maybe political or tax uncertainty just keeps clients on the sidelines, waiting for things to clear up.
So here's our official call for next quarter. We think they'll probably hit their retail inflow target, let's say around 20 billion reals. Management sounds pretty confident there, but we expect the stock to stay volatile, kind of stuck in a range. The market is going to be in wait-and-see mode until there's clear proof that growth is back for good. So we're rating it market perform. That amazing profitability provides a nice floor, but the uncertainty around growth is definitely going to cap the upside for now.
And that really brings us to the ultimate question for XP and its investors. They've already proven they can be incredibly profitable. The question now is, can they reignite that growth engine before the market completely loses patience?
And as always, a quick reminder, this is not financial advice. Please be sure to do your own research.